Welcome to our monthly view from the Edge for September 2021. I'm Fritz, Folts, Chief Investment Strategist here at 3Edge, and I am joined here once again today by Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3Edge Asset Management. And as we do at the beginning of each month, Eric and I will provide our firm's most recent update of the global capital markets, and we will take a look at the major asset classes that we model to see if there have been changes over the course of the month of August in our outlook. So let's get started. Here we are, Labor Day, summer now in the rearview mirror. U.S. equity markets continuing to hover around all-time highs. However, the investment landscape may have begun to change recently now that the Fed has explicitly signaled their intention to begin to taper their monthly $120 billion of bond purchase at some point in the months to come. So Eric, maybe first you could take us through our 3Edge dot plot matrix of the major asset classes that we cover and point out whatever changes have occurred since August.
Yeah, thanks, Fritz. Yeah, we see just a few changes here. Europe moves down a notch, but still positive. We'll get into some of those details. Developed Asia, and in particular Japan equities, have moved up a notch. And then we see rates and credit going down a notch to a slightly negative outlook. But we'll touch on all of the asset classes in this month's podcast to make sure we cover everything.
Perfect. All right. So let's take a closer look at those, and let's begin with the U.S. equities, which, as I stated, continue to hover around all-time highs. What are we seeing there?
Sure, yeah. So I think there's three things to focus on here. One is that U.S. equities are overvalued. Inflation's heating up, and as you noted, the Fed's intention to dial back bond buying. So let's get started there. So U.S. equities maintain this level of significant overvaluation by our measure, and we've noted that for some time. And I just want to pick up on a note here, which is that we continue to evaluate our valuation method and continue to test our approach and our assumptions within this approach. We want to make sure that we can be confident that the way in which we're performing this valuation is fair, and we do feel good about it. For U.S. equities to be more fairly valued, one would have to assume that today's low interest rates would continue on forever, and to us that just seems highly unlikely. In terms of CPI, that's been heating up. We started the year around 1.4% year on year, and the last two prints have been 5.4%. And that's elevated, but the fact that it hasn't been going up, that it just stayed the same, perhaps that could be some moderating that's taking place. The survey for August print, which we'll get later this month, is set to be 5.3, so it ticked down. And so that's going to give the Fed some of that much needed cover to align with their transient narrative about inflation. A more persistent or increasing inflation puts the Fed in a tough spot. In theory, they're going to want to cool the price pressures by reducing stimulus and raising rates. But if they do that, they run the risk of cooling down the economy, which could impact the employment negatively, their other mandate, right? So it's really a rock and a hard place. In terms of the last point, which is the Fed tapering, at the Jackson Hole meeting last month, Fed Chair Powell reiterated his commitment to, and I quote, continue our asset purchases at the current pace until we see substantial further progress toward our maximum employment and price stability goals measured since last December. So market participants celebrated this, concerns regarding Delta variant, hiring trends, inflation prints will no doubt be in focus for the Fed as they contemplate reducing bond purchases perhaps this year, as you noted. They have 3 meetings left this year, one later this month, one in early November, and their last is in mid-December. So even a modest scale back of bond purchases may unnerve investors, could cause some uncomfortable market volatility. So taken all together, it's a long-winded overview of the U.S., but taken all together, the outlook for the U.S., in our opinion, is neutral or mixed. There are some positive economic factors, but they're being offset by this negative valuation and corresponding behavioral factors.
Excellent. Let's shift geography now and take a look at Japanese equities, which actually recently hit a 5-month high. What are we seeing there?
Yeah, Japanese equities have really been on the move as of late. You noted the 5-month high. That's probably looking at the more popular Nikkei 225 index in local terms. In terms of a more broad-based index that we model, the MSCI Japan index, you'd have to go back to the summer of 1990, just following Japan's last peak from their real estate and stock bubble. that peaked in December 1989 to see these levels where they're at now. The presumption, I believe, is that there's this investor excitement due to the recent announcement that Prime Minister Yoshihide Suga will not seek a second term. He's been criticized for his handling of the COVID-19 pandemic in Japan, and perhaps investors are simply excited for any change. There also remains the possibility of even more stimulus from the Bank of Japan. So, our research is signaling continued bullishness for Japan.
Excellent. And then we'll go across the pond, if you will, to look at European equities. Also have had a very strong year-to-date performance in 2021. What are we seeing there?
Yeah, European equities have rallied this year on the heels of continuing support by monetary stimulus from the ECB, alongside some positive investor behavior that we've seen. However, a risk that we noted last month and continues to be of concern is this continued upward pressure on European inflation.
Right.
And we noted that this could result in the ECB changing tack by tightening their policies perhaps sooner than market participants were anticipating. And interestingly, just this morning, as we record this now, it's being reported that, in fact, the ECB will slow its pace of net asset purchases due to inflation concerns. Now, their inflation is only 3%, or it's surveyed to be 3% this month. But from the European perspective, particularly in Germany, which is very sensitive to inflation, that could be a big deal. This has the potential to have a negative impact in the short term on European equities. But it should be noted that overall monetary policy still remains highly accommodative. There are still going to be continued asset purchase, and there were no changes to their main interest rates. Their main refinancing rates still at 0%, lending facility rates still at a 0.25%, and their deposit facility still at negative 50 basis points, or negative 0.5%.
Very good. And let's take a look into the emerging markets, and in particular, India. India equities also recently reached a record high. So what are we seeing there?
Yeah, the research is suggesting Indian equities, to be supported by this positive investor psychology as we measure it, declining short-term interest rates, steepening yield curve measures, all good things for the Indian equity market. Accommodative monetary and fiscal policies are expected to continue as they head into these upcoming elections. Interestingly, on a geopolitical front, the situation in Afghanistan could actually bring the U.S. and India even closer together, since Pakistan is an ally of the Taliban.
That's right. That's an interesting geopolitical development there. One last equity market would be China. Chinese equities really suffered some declines here as investors are trying to figure out exactly what this recent government policy initiatives, what do they mean, because they don't seem to necessarily be friendly to Chinese tech companies and other companies in China. So what are we seeing in China?
Yeah, the outlook for China equities remains mixed, or neutral, as we would call it. There's a good deal of uncertainty among investors all around the world about the recent policy decisions that you noted, the Chinese government, and the potential negative effects of these policies on both the Chinese economy, but also more broadly the whole global economy. Yeah. The upshot is perhaps much of this is already priced in to the equity markets at this point. So maybe those selling pressures are accounted for. And we are seeing steepening yield curve measures, which could be a positive sign for the region. But so you have some positive economic factors, but some negative effects from the new policies. So taken together, a bit of a mixed outlook.
Great. So that's it for the equity asset classes where, I think we're finding better value, if you will, outside the U.S. Let's switch gears now and look at the fixed income markets, both interest rates and the U.S. Treasury market, as well as the credit market, the corporate bond market. What are we seeing there?
Yeah, we notched rates down as the risk-return trade-off in U.S. Treasuries just remains uncompelling as the entire Treasury yield curve continues to yield less than the expected rate of inflation. The risks of rates rising far outweighs either the potential for capital appreciation on declining yields or the carry that you might get from yield on Treasuries. So hence that notch down. Credit spreads, in terms of credit spreads remain near all-time low levels. And as we've noted, the risks of a rapid unwind combined with just a very small extra yield pickup relative to risk-free bonds just suggest, again, just an unattractive risk-reward profile at this time, we believe, for our clients for corporate bonds. Should the global economy slow from here, it could cause problems in the high-yield bond market. And in this circumstance, we could see high yield spreads widening, which would likely negatively impact credit in general.
Absolutely, absolutely. All right, shift gears once again. We'll look at the real asset market, which includes gold and commodities. Commodities, in particular, have turned in a strong performance here to date, but it seems that they are somewhat less attractive, at least in the short term now in our model research. So maybe you could dive in a little bit into gold and commodities.
Sure, yeah. Well, yeah, gold has struggled so far in 2021. It's went down, then it recovered a bit, but still down on the year. But it remains a relatively attractive asset class. It's being supported by negative real yields, which is a boon for something like gold. That is nominal yields less the expected inflation rate. And as we noted earlier, the concerns around the Delta variant, peak growth, an uneven recovery in labor markets, this could delay the Fed's plan to taper, and that in theory could lead to higher gold prices. As for commodities, they are perhaps a bit less attractive in the shorter term, as we've noted an increase in this negative investor psychology towards this asset class. Investors may also be concerned about the recent restrictive government policies in China, which we just noted, which wouldn't only harm China or China's consumption or demand for commodities, but the overall global economy. All that said, though, commodities do remain attractive in the medium to longer term, since they remain relatively undervalued on an absolute basis, but also when compared, say, against something like U.S. equities.
Right, they have some catching up to do still, so that's encouraging. All right, great, Eric, very good. Rapid fire took us through all of the major asset classes, which is good. The summer's over, now we're into fall. We're looking towards the rest of this year and beyond. So it's an excellent update on our model research. And so that will do it for Eric and me. We will be back again, though, in the beginning of October with another edition of the 3 Edge View from the Edge. And next week, Steve Cucchiaro and I will end our August hiatus and do our next 3 Edge Week in Review video. Remember, all of our videos are available on our 3 Edge YouTube channel or on our website at 3edgeam.com. So on behalf of Eric and me and everyone at 3 Edge, we want to thank you for listening, and we'll see you next time.